guys, good morning, July 30th, 2019. In this video, we're going to talk about federal rate decision. This week, we're going to tell you exactly what's about to go down on July 31st. This morning, we're recording this on July 30th, about 9 a.m. before the market opens. So in this video, we're going to specifically touch on what history tells us is about to take place, what charts point to, and how to actually trade it. So if you're a swing trader or a day trader, here are the answers that you have been looking for. I know everybody says, whoo, shit, it's a crash. It's a top. We are at the top, guys. I don't know what these guys are telling you, or whoever's telling you, or where they're getting this information, but clearly they have not taken a look at the chart of S&P 500 on weekly. I mean, we are above the prior tops. This is your top 1, top 2, top 3, so they're saying this is top 4. We've been the advocate for the last 30, 60 days. The markets is going to move higher, creating these all kinds of crazy bullish patterns everywhere we look, buying the dip, buying the dip. So we've temporarily converted from a bear to a bull, and it's been working on multiple trades. So here's the past prior tops to just bring the point out to you guys. 1, 2, 3. Okay, at this point we're above. Another way to look at this, besides the clear symmetry, okay, how symmetrical these moves are higher here. Another way to look at this is where we are. Another cup with a handle, and we are at this point beyond the breakout point, beyond the buy point. So very important. If you hear people say in the news, oh, it's a top, it's a top. Guys, they're not looking at the charts. These people don't have a clue what the hell they're talking about. Okay, so with that said, here's what's going to take place tomorrow. There will be a quarter-point rate cut. First cut in 12 years. All right. Well, the question is, why only a quarter-point cut? The charts of dollar and gold are telling us so. So let's take a closer look. Here's what's going on with dollar. And for those of you that may be new to trading, let's just break this down. Lower rates mean weaker dollar. Okay, so the question is, then why has the dollar been going higher? I mean, everybody knew this rate decision was coming up, so especially in the last few days, what's going on? Look at the dollar moving higher. What's up? The dollar should be going lower, but yet, they're buying every dip in the dollar. Look at this crossover right here. Blue line crosses the orange line. That's a bullish crossover, guys. Also on the MACD, we're about to have a bullish crossover as well. So dollar moving higher. If they actually expected the Federal Reserve to cut the rates by half a point, dollar chart would not look so damn bullish. Okay, let's take a look at a different time frame on US dollar. What do you see? Whoo, this is like a cup with a handle or a skillet with a handle. Sometimes the handles, we call them skillet with a handle because the handle is just not as deep, but there's clear signs of a handle here. And when it coincides, especially with these bullish crossover, the blue line crossing the orange line, on multiple time frame charts, guys, it tells you that, hold on, something is going on, okay? Something is going on that is not supposed to be going on. The dollar is supposed to be going lower, but it's moving higher. So we actually got a perfect case here of a divergence. And when these divergences happen, that's something to pay attention to. So as far as another way to look at the USD chart, right, you got the happy, smiley face looking at you right here. Basically, another way to look at it on the daily chart is what we're looking at now, is the fact that we got a reverse head and shoulder. Here's your shoulder 1, shoulder 2, here's your head. Now it's reverse, right? So basically, we're saying that US dollar could move back to this 98 and a quarter. Now that would coincide with a possible top here, which would coincide with the announcement tomorrow that Federal Reserve is only cutting rates by a quarter point, not expected. So initial reaction in the dollar is going to be the pop. Now let's take a look at gold. By the way, we're also getting this smiley face right here in the MACD. MACD is telling us, hey, smile, smile. Dollar temporarily going higher. Now, I know everybody's been bullish on gold, but that's not what the chart is pointing to. The next move in gold, the next move in gold is going to be lower. So we think the initial reaction of gold to only a quarter point cut in the rate is going to be lower. This is why we're seeing a lot of people actually coming in and taking profits in gold at these levels of 14.20 to 14.60. Now, overall, we are bullish on gold. We do believe it's going to revisit its prior levels over the next 24 months of $1,600, $1,800 bucks. But right now, the next move is going to be lower in gold. we're looking at the weekly chart here. We're noticing some early signs of a divergence, right? So as the price in gold actually goes higher, we're noticing people start to get out. They're starting to distribute their positions. They're starting to lock in gains at these levels, which is confirmed by these bearish reversal type candles. Guys, if you don't know what bearish reversal candles are, click the link below. Take the charts divergence pattern recognition course. So you can clearly understand what the hell is going on here on this chart. Okay, gold. On a daily chart, same thing. We've got multiple confirmations, multiple divergences. Now, here it's a little bit more pronounced, so it should be a little bit easier to see even if you're brand new to charts, right? So look at this. This line goes lower as this line moves higher. Typically, when the price action goes higher, okay, you would want this line, the accumulation distribution line, to also go higher. Now, as you can see, it's doing exactly the opposite. Also coincides with this bearish crossover in the MACD. So since gold basically got to 1400, 1450 level, it's been a lot more sellers rather than buyers, which is also portrayed in this red candles. Anytime the candle's sticking out like this, it actually tells you at the higher level there's a lot more sellers rather than buyers. So by the end of the day, price action comes back down to earth from the moon, signifying that, hold on, this is going to be a level. It's going to be pretty tough to clear. So we're not expecting this level to be cleared. Initial reaction in gold is going to be lower. Now, hold on a second. This makes no sense. When they cut interest rates, gold is supposed to be going higher. Well, maybe this move in gold has already priced in the fact that, okay, we are getting a rate cut. That's why we already had this move here. Now, because we're not going to get as of an aggressive cut, we're showing these bearish signs on the chart of gold telling us, hold on, it's not going to be half a point. It's only going to be a quarter point. So with that said, to summarize it, nice and easy, key takeaway from what I just shown you guys is dollar goes higher after the announcement and into the announcement. And you will see the initial reaction after the Federal Reserve announcement is dollar's going to go higher. Now, dollar higher is not good for overall the stock market because, as you know, a lot of companies, especially the ones who do business overseas, stronger dollar actually impacts their profits when they report them here in the United States. So stronger dollar is not desirable condition for the markets to go higher. So dollar pops, market drops, okay? Gold initially falls, but overall, let's not forget, over the course of the last 30, 60 days, we have a lot of bullish activity going on in the behavior. Known to everybody as buying the dip. Buying the dip is back in style. So when gold actually drops, guess what's going to take place? They're going to come in and they will buy the dip in gold. When they're going to start buying the dip in gold, you'll also see the markets will be reversing and moving higher. So remember, all you got to do is buy the dip. Okay, so here's the bottom line. US dollar should not be so bullish. Gold should not look so bearish going into the federal rate announcement. So therefore, institutional investors are not calculating a half a point cut. They're only calculating a quarter point cut. Okay, the next question we're going to answer here is, what does history tell us about the first rate cut after a cycle of rate increases? Very important question, and here's the historical data. Guys, take a look at this slide, print it out. This is the most important slide I have shown you in the last 6 months. Take a look at this. Goodness, if you go try to find this information, y'all, it'll take you forever. Okay, so the first rate cut cycle, 1983, okay, we cut the rates from 9.625, just a bit, by only 13 basis points to 9.5. Second rate cycle, October 1984, from 11.75 to 8.25 over the time frame of 12 weeks. So when you're looking at this part of the table, what you will see is the duration. How long did the cycle of rate cuts actually last? So anywhere from just 1 week, 0 weeks, to as long as 170 weeks. Right, in 1989, when they began cutting rates went from 9.75 all the way to 3.0, decrease of 675 basis points. Now, on this column right here, guys, you will actually see a response in S&P in relation to the initial rate cut. So specifically, these numbers right here represent the reaction to the Federal Reserve interest rate announcement, the beginning of when they initially cut the rates, going 3 months out from that initial cut. So 3 months out from this initial cut, you only see in 11 instances where the markets actually were negative 3 times out of 11 cases, guys. Now, notably, the last 2 cases where the markets dropped 3.8 and 17.7%, we've had a situation where Federal Reserve actually started cutting rates too late, okay? Therefore, the tech crash in 2001 and the 2008 crash. If we take these 2 abnormal cases out, we only had 1 instance of when S&P 500 actually moved lower. So this gives you actually anywhere from 73% probability of the market actually moving higher after this rate cut, and as high as 90% probability of the markets moving higher after this rate cut if we decide to take these 2 abnormal situations out of this equation when we calculate these percentages. So overall, you get a 73 to 90% probability of the markets moving higher 3 months after this initial rate cut. Now, keep this information in mind, because you're going to say, hold on, Leonardo, this makes no sense. First, you say the rate cut is only 1/4 point, but everyone is expecting half a point cut. So, don't you think this would make the market drop? Because I'm telling you, I'm thinking this, Leonardo, and I think the market is going to crash. And you are wrong, dude. You are so wrong. Guys, this is actually a very good question. I love it. You know, deep down inside, I am a hardcore bear, so thoughts like this do come to my mind, okay? However, I cannot ignore the charts. I cannot ignore the history. With that said, this takes me to the next most crucial point of this video, okay? And that's our historic analog, okay? And now a 13 markets move daily subscription analysis. We've been showing this analog over the course of the last 30, 60 days, and it's been rather accurate almost on day-to-day basis. So let me show you specifically what makes us think is going to take place exactly in the next 48 hours. So as you can see, there's a lot of drawings here, a lot of points, July 5th, July 17th, so on. This is where we are in this historic analog right now. Okay, historic analog. By the way, guys, if you have not watched the documentary I've posted about historic analogs on this channel, make sure you do that. I'll post the link at the end of this video. Just click it. Make sure you watch this video to the very end. You'll be able to click that link and check it out. So now our video, guys, if you're a trader, guys, check this out. There's some really crucial, important information. But for the purpose of trading today, tomorrow, next week, here's what you need to know. The historic analog basically points that today is kind of going to be, and that's what we said in our 13 Market Moves Daily subscription yesterday on Monday, the 29th of July. We said, look, the market's going to go sideways for a couple of days. We're actually going to get these big red candles. So for those of you bears, congratulations. Yes, the market is going down for just 1 day. So don't always stay in that party, okay? Do not be the last one to live. Don't stay in it for like a few days. Just make sure you're only having a good time for 1 day. Okay, because what's going to happen the next day, based on the historic analog, after we get the initial drop, so the Fed comes out, says 1/4 point cut, the market drops, and then the next day the market reverses and starts going higher for 27 to 28 days in a row. Now, just because we're saying 27, 28 days in a row, clearly if you look at the historic analog, you got a stretch of multiple days higher. And then you see some red candles here in the historic analog as well. Now, the beautiful part, if you are a bear, you're absolutely going to love this, because the historic analog actually points out a time frame right here at which we're going to be paying very close attention when it's going to be time to short the hell out of the market, and that's where a ton of money is going to be made. However, I just don't want anybody to miss out the opportunity to make the money on the bull side, because that's what the history points out is going to take place next. So with that said, let me zoom back in here. The initial reaction will be a drop on July 31st, followed by a bounce on August 1st, because they will come in and they will buy this dip. So followed actually by 27, 28 days of markets moving higher. So it's kind of going to look like this, right? So initial reaction lower. So you're going to see the markets do this probably for the whole day. Tomorrow on July 31st, or definitely you're going to see this. You're going to see the market doing this after 2 p.m., 2:30 announcement, when the press conference is going to kick in at 2:30. You can see the market doing this. But then you're going to start seeing the market doing this over the course of the next week. But notice, it's not like a straight shot higher, right? There's going to be some dips. They're going to come in, buy the dip, buy the dip, move higher by the dip. So it's not a straight move higher for 28 days. Some days will actually begin in the red and then will finish in the green. Okay, guys, key takeaways. Okay, very simple. Buy puts Tuesday before the close. Tuesday is today, so before 4 p.m. Okay, wait for a nice bounce. Buy puts on the bounce. Tomorrow morning, on Wednesday, if you don't buy puts today, buy puts tomorrow morning, July 31st, just for a day trade, right? Make sure you're closing your puts around 3:45 p.m. tomorrow, July 31st. Open calls right before the market close, 4 p.m. And look, just remember, stocks take the sweet time to climb higher. So because the historic analog shows a sharp move higher, it does not necessarily indicate 100% that we're going to get a rocket to the moon higher. What it does say that overall, over the course of the next 27, 28 days, the market will move higher rather than lower. So as you're looking at all this stuff, just keep this in mind that you don't necessarily want to buy calls that expire this Friday. You want to buy calls that are expiring the following week. Give yourself a little extra time on this call trade when you see the dip tomorrow after the initial response to the Federal Reserve announcement. Guys, with that said, if you're trying to learn more about charts, click the links below. If you're trying to understand the 13 markets move formula that helped us predict all the major market moves when the markets was crashing last year in November, December, when the markets turned around in December, when the markets were moving higher, lower, guys, we predicted pretty much every freaking move in the market over the course of the last few years. So using the 13 markets move formula, if you don't know what the hell it is, if you're trying to understand, if you're trying to be a better trader, guys, click the link below, get more information, but don't trade without it. With that said, guys, have an awesome trade, and then tomorrow I'll catch you on the next trade in the next few days.